And now it's time to welcome our special guest, Dennis Gartman, retired editor and publisher of the Gartman Letter, and also a CNBC contributor, as well as the chairman of the Akron University Investment Committee. Dennis Gartman, thanks so much for being back here with us on the Income Generation.
Well, you guys are scraping the bottom of the barrel and found me once again, so here I am.
Well, we have a lot to talk about because we last spoke pre-pandemic, and of course the world got flipped upside down and right side up again. I know Jeff didn't get the chance to be with you last time, so Jeff, I'm going to defer to you.
So lots has changed over the last 12 months. What a whirlwind we've been on. But, we have to look forward from here, Dennis. We've got a flattening yield curve, inflationary issues, oil has doubled. There's going to be some headwinds, less pent-up demand going up next year. What's your forecast for the next 12 months in the markets at these new all-time highs?
Well, first of all, it's been a bull market, hasn't it? And it's been an extraordinary one founded upon the Fed's monetary expansionary policies. And it's not just the Fed, it's the Bank of Canada, it's the Bank of England, it's the ECB, it's the People's Bank of China. Indeed, the People's Bank of China over the weekend did something that used a 2x4 to the mule's head of the world of the Chinese economy by lowering the reserve requirements, which is the most expansionary circumstance you can get other than going out and doing what the Fed has been doing, which is buying Treasury securities. So it's been a bull market. It's probably going to continue to be a bull market. You can write this down. It's going to continue until it stops. That's the best that I've been able to come up with in 45 years of being in the markets. I'm surprised by how strong it has been. To be quite honest, there have been times in the past when I've been expecting to see the market correct. It corrects 2, 3, 4, 5% at most. It doesn't have 5, 10, 15% corrections. And as long as the monetary authorities remain expansionary, we probably have to continue to think that the market will continue to move from the lower left to the upper right. It's been a bull market. Don't fight it. Don't fight the Fed.
Yeah, with these expansionary tactics by the Fed, it sure seems like they're disconnected, but it makes me feel like they're worried about what could happen next. Is the variant going to become a player and there's going to be shutdowns again? Are there going to be foreclosure issues in the commercial space or the residential space? And so I'm concerned that they may never let the market fall. The next thing they could do is start buying stocks, right?
Well, first of all, the Bank of Japan has been buying stocks for a number of years. And has proven that they can continue to do that for a long period of time. I hesitate to think that the Fed will be in buying stocks, but there's no reason to think that they can't do it and won't do it if push comes to monetary shove. They have that capability. I'm surprised by the discussions of it, but they can do it. When they do it, they'll do it via ETFs. They won't come in and buy individual shares. They'll buy ETFs just the same way the Bank of Japan has done it. It's some time yet before they actually attempt to do that. And they probably won't do it unless we see that this new derivative of COVID becomes much worse. I hope that that's not true. I hope that doesn't happen.
Well, they just bought a bunch of corporate ETF bonds, right? And they're offloading their bond balance sheet. I think they bought $14 billion in corporate bonds to reassure the credit markets. I mean, last year they virtually guaranteed every bond in America, municipal or corporate.
Yes, they in fact they did. They bought every Treasury security. Well, I shouldn't say they bought every Treasury security. But they bought 75 or 80% of the Treasury supplies. The Fed has been monetizing the Treasury's debt, and they're going to continue to do that. They've made the promise that they're going to continue to do $120 billion worth a year, and I see no reason to think that they're going to change that anytime soon.
So, Dennis, what are your thoughts about inflation? What are your thoughts about inflation, Dennis? It's been is it transitory? Is it more permanent? What's your crystal ball say?
I don't think it's going to be transitory. I think that this is a rather permanent circumstance that's prevailed, unless the monetary authorities suddenly decide to have a massive tapering of their purchasing of Treasury securities, unless they actually start to begin to sell Treasury securities, which they'll never do. They'll only let things roll off, but they're going to continue to buy. And as long as they do that, as Professor Friedman taught us, inflation is always and everywhere a monetary phenomenon. And you can't grow the monetary base, the adjusted monetary base, which is the stock from which all other monetary aggregates are derived. You can't have the adjusted monetary base growing 25, 26, 27% per annum without having an aggressive inflation. So the numbers that we start to see in the past several weeks, 2 days ago, we saw CPI, yesterday we saw PPI, both of them well above the worst expectations, showing inflation to be running 5 and 6 and 7% per annum. that's going to be, I think, something we're going to have to live with for a long period of time going forward. Now, yes, indeed, there are exogenous circumstances, pipeline availabilities, the problem that occurred in the Suez Canal earlier this year, the backups at the nation's ports here in Norfolk, where I live, or in Los Angeles on the West Coast, even in Seattle on the West Coast. We've had backups in those ports and the inability to get ships in and out. Now, those have been I think those are transitory, but the real problem, the monetary authorities have been expansionary and see no reason to think they're going to change. So this is not a transitory inflation. This is an indigenous, long-standing circumstance that I fear may get worse.
And the textbook says, of course, that the Fed should be raising rates to fight off inflation. But so is that our biggest threat? Briefly, is that our biggest threat now to the financial markets? The one thing that's most likely to topple them when the bull market eventually does end?
As long as we don't get inflation above 4 or 5% on a consistent basis, I think we can live with it. It's hard for me to believe at 70 years old that I actually would say that make that comment, but I guess we're going to have to learn to live with 4 or 5 or 6%. And the stock market can probably take that in stride without being too deleteriously affected. When you start to get above 7 and 8% inflation, and that is a possibility. It's not a probability, but it is a very distinct possibility. When you start to get to 7 and 8% inflation, that can be very detrimental to the stock market. So what does the stock market fear more than anything else? An inflation rate that gets to 7, 8, 9, 10%. And again, with the monetary base expanding at 20 and 22 and 25 and 28% per annum, depending on which starting point you use, you're going to get higher levels of inflation, and you have to be on the watch. So I think the trade is to still own stocks, but at the same time own gold, which normally the two move in contravention one to another. I can make the case that they both move in convention one with the other, both moving from the lower left to the upper right.
Yeah, my biggest concern is that even at 4 or 5%, traditionally the Fed overreacts, starts to push us toward recession, and that affects the stock market. But like you said it perfectly. The bull market will continue until it no longer continues. Dennis Gartman, thanks so much for being back with us here on The Income Generation.
It was my honor.